Please welcome to the stage Richard Lucage, Senior Managing Director from Bank Street Group.
Well, I'd like to invite up the rest of my panelists for this morning, and thank you to all of you for being here with us this morning, and I'm looking forward to what will likely be a brief but very enjoyable exchange, and we'll try to incorporate the audience into Q&A if we have time. So next I see Bill Fathers.
Your future.
Welcome. Thank you. Jonathan Skilkraut. It's quite the show. Welcome. And Jeff Ferry. Welcome, Jeff. So, gentlemen, just to do justice to each of your backgrounds, I'd like to maybe kick off by a bit of an introduction of each of yourselves and your organization so that the audience can have a little bit of context for our discussion here this morning. And as we all have somewhat of a limited timeline here, we thought we'd jump right into it after that. So maybe we start with you, Bill, and spend a minute or two on each of you with your backgrounds.
Thanks, Rich. I'm Bill Fathers. I'm here with Stone Peak Infrastructure Partners. We're a New York-based private equity firm. And I've been in private equity for about 2 years. And prior to that, I had a 17-year run with a real job as an operating executive, running a few companies, mostly in the infrastructure space. Companies like Savis Communications, which you may remember was subsequently sold to CenturyLink. And spent several years running VMware's cloud services business as well. I'm based in Silicon Valley and spend a fair bit of time tracking the progress of the major cloud services companies. But for now, I'm now in private equity and happy to talk about that as well.
Fantastic. Jonathan?
Hi, Jonathan Chilkraut from Cyrus. Oh, we're going down here, folks. Jonathan Chilkraut from CyrusOne. CyrusOne is now a global data center operator. I'm the Chief Strategy Officer over there. I joined about 10 months ago, and I spent the prior 15 years on Wall Street as an equity research analyst focused on the communications infrastructure space. So data centers, towers, fiber, and sort of the bridge between those three areas.
Fantastic. And Jeff?
Yeah, it's Jeff Ferry with Goldman Sachs. I work in a group within within Goldman. It's a principal investing group globally. Invest about $28 billion in Europe, Americas, and in AsiaPac. I've spent the majority of my time, probably the last 10, 12 years, looking at data centers, infrastructure, telecom. We've done a number of investments in platform companies like ViOS, DataPipe, Valis, not CyrusOne. And then recently also investments in AirTrunk in Sydney and Melbourne, and also Accelerate in Russia. So see a lot of opportunities, globally in that sense. And then I was told last night, AirTrunk, the guys at AirTrunk, they have a new tagline, and it's we build it just a little quicker and just a little cheaper than CyrusOne.
And for those of you who don't know me, my name is Richard Lucage. I'm a founding partner at the Bank Street Group, which is a investment banking firm that focuses on the technology, media, and communications sphere with a global perspective. I wanted, and given the sort of title and substance of this panel, I wanted to maybe open up to each of our players that we have, a lending institution / capital provider. We have a former Wall Street, now turned to the dark side operator, and vice versa in the case of Bill. But I think each of you has a great perspective, and obviously over the course of the conference here and over the course of our own traffickings across the ecosystem, we've seen a lot of activity afoot. So I'd like to maybe compartmentalize them a little bit and talk a little bit about, at the outset, about sort of the flows of capital, where you see maybe in each of your organizations what the flows of capital means to your organization, and maybe where you're prioritizing your own initiatives, and maybe we'll use that as a way to begin to talk about strategy and other topics.
Good.
So
Shall I start,
with
Rich?
you, Bill? Sure.
Very good. Stonepeak has around $15 billion of assets under management, or fund size. And if we look at the amount of investment we're putting into the communications infrastructure relative to oil and gas, transportation, water, and other sectors, you've seen an ever-increasing percentage being allocated to communications. And I think, if we also take a step back and look at the amount of capital that's going into the build-out of digital infrastructure, say in 2018, relative to some of the other sectors like oil and gas, it's kind of eye-watering to see the hundreds of billions of dollars that are now going into building data centers and networks around the world. That starts to even dwarf the amount of investment that goes into oil and gas exploration and pipeline builds. So not surprisingly, given that trend of more and more capital going into digital infrastructure around the world. And I guess the second thing we'll all probably reflect on and talk about is there seems to be this sort of very deliberate global theme of North America trend slightly further ahead, and then followed by Asia and markets in Asia, followed by Europe. But it's sort of highly predictable trend of where the capital is going to be needed. You can sort of see the growth occurring in each market separately. But it feels like the trend is an ever-increasing percentage of capital demand is going to be coming from this communications sector relative to oil and gas and utilities. Although obviously there's a knock-on effect, because if we do build, what do we think is going to get built this year in North America alone? 500 megawatts, 700 megawatts of data center capacity. The upstream power implications of that are obviously pretty material as well.
Absolutely. And maybe before we go to Jonathan, can you comment at all about, you talked about the evolution towards communications infrastructure and services as a prioritization. Maybe can you distinguish where your priorities are in that ecosystem, distinguishing between data center, broadband infrastructure of various types, wireless infrastructure, et cetera?
Yeah, I think we are, I guess, participating with small cell, tower, fiber, and data center. We try and find, it makes us sound clever, but we're trying to find strategic control points, which, let's say what that really is. I think, the good news is there's just an enormous amount of demand, driven obviously by mobile data and cloud computing and a number of other drivers. And therefore, a lot of capital is being put to work. I guess we try and find the areas of opportunity where you're investing in infrastructure that has some level of sustainable differentiation. And that seems to be coming in a number of different ways. One thing that, coming to this event really helps me realize is the biggest buying segment, this very large cloud and content providers, they're typically looking for, something slightly different to what providers have been traditionally delivering. They seem to be looking for things that are typically more efficient, if it's subsea cable or data center or fiber optic cable. They're looking to absolutely push the boundaries of performance relative to price. And a lot of providers are having to, and I think, obviously one, CyrusOne sitting next to me doing an incredibly good job of this, is pivoting quickly to be able to build something that is at scale and far more efficient. So one of the factors we look for is, are you building something that's sustainably efficient enough to service the needs of that biggest segment?
Fantastic. Jonathan?
In terms of our capital priorities, I probably cut it two different ways. Organic growth and inorganic growth, and then sort of domestic and internationally. When we do our planning for the year, we really look at primarily putting our capital to work in organic growth. And on balance, organic growth will give us the highest returns relative to M&A activity. So we definitely want to put our own capital to work on our own projects from the ground up. That being said, the reality is that this market, this space is evolving so quickly, and the need for expanding your reach ultimately so that you can better serve your customers is really compelling. And so over the last year, we've made a number of investments outside the United States. We put $100 million to work in GDS, which is the leading independent data center provider in China, which was a critical investment for us, because when you think about sort of the global landscape, there are really only two countries that have created hyperscale cloud providers out there. That's the US and China. And to have a strong foothold in each of those markets was very important. But at the end of the year, we also bought our way into Europe through Xenium, giving us a presence in both the UK and in Germany. So we increasingly feel that customers are buying globally and want one hand to hold, and with a concentration of that demand into fewer hands, we want to make sure that we're well positioned. So primary focus would be organic, recognizing that we have to do more on the inorganic side. And then in terms of domestic versus international, I'd say that today it's still primarily domestic because out of our 45 data centers, 90% are in the US. But I would argue that we will be making an increasing amount of investment on a global basis going forward.
Makes sense. Jeff, maybe you have a slightly different perspective from a financial provider's view. Obviously, the flow of funds is part of your goal to deploy, and maybe you could share your perspective on where you're prioritizing your time and how you're thinking about the opportunity set, whether it's domestically and abroad as well.
That's a good point. I've been on these panels before with Jonathan. This is the first time I've gotten to talk, actually. Usually by the time Jonathan is done, the time's up and we're all like saying goodbye. So I appreciate you giving me some time. So yeah, so it's actually interesting. We have a pretty big strike zone, right? So we can go anything, provide any capital from senior debt through and including preferred equity. So, you know, when we see an opportunity, and this is also globally, right? So we have the benefit we have people in all the markets, right? So on the ground, knowing the market, we've got guys in Moscow. We've invested in Moscow and in Russia for a number of years and been fairly successful at it. So when an opportunity came to invest in a data center there, we leveraged the local folks we have there, plus our, the folks we have in London and the team there, and, kind of our knowledge base and history of investing. So we're able to invest capital there. Same with AirTrunk in Australia. We have feet on the ground there, so they know the local market, know the local banks, know the local situation, and we have people in China and in Hong Kong and in Tokyo and all over down in South America. So it gives us a local kind of flavor and to be able to really understand the local laws, the local jurisdictions. Where do we want to invest capital? Do you want to invest debt? That may not be the best situation there because of collection, and how do you get into it? How do you, can you be secured, not secured? So then we may pivot towards, well, we'd rather be then, mezzanine or preferred because we want that return and have the local banks maybe finance it. So I think, we look at opportunities as they present themselves, globally, and obviously it's more than just telecom infrastructure that we're investing in. We invest in, real estate and other asset classes. But I would say, we like obviously this asset class. Truthfully for us, because we've been in the debt for, a number of transactions, it's hard for us to keep it out because, there's so much M&A, there's so many other opportunities that go out there that we have to try to continually recycle that capital. So,
sure.
And constantly look for new opportunities.
Well, maybe a follow-up for you. I mean, we have clients come to us often with a question about how to navigate sort of the new world order on capital, and for companies of any size that are looking to do a transaction, it's sometimes a little blistering, even among the more sophisticated finance offices, to try to figure out if my right funding partner is an infrastructure fund or a sovereign fund or a pension fund or who makes direct investment activities, and some of whom actually also cross-pollinate between debt instruments and structured debt instruments and even structured equity solutions. Then you obviously have all the finance cos and even traditional banks that are venturing into abilities to play at various layers. How do you see that kind of a plethora of financial products? And obviously it's been good for our business to provide advice for people to find the right avenues, but as someone participating in the marketplace, how do you navigate that?
Well, it's easy for me. I just tell them to call me. We can do it all. Don't worry about anybody else, right? I think the difficulty is if you're just focusing on one piece of this capital structure, and then trying to maybe fit what you do into that, right? So, for companies that are what we like about the infrastructure is it consumes capital, right? So whether you're organically growing and building out, or you're acquiring, or you're building out new markets. So, that allows us the opportunity to provide more capital, grow the platform, kind of continual, kind of feed the engine. And so from that aspect, I think it's, kind of focusing, kind of as Jonathan said, it's like, what's your main priorities, right? It's like when you raise capital, you get into the conversation like, where's your highest return, right? Is your highest return building, Dallas 2, or is your highest return going to a new market? And I think that's, kind of part of the process of understanding, how much capital do I need? What's the best return? And then, do I need to do M&A, or do I need to grow here? And so I think we've seen, we deal with a lot of management teams and families who own, kind of like, not just private equity groups. And so, it's a little bit tougher for them to kind of really kind of get their arms around that, because they may not either have as much sophistication or haven't been in the capital markets that many times, right? So those are actually very interesting conversations for us, because it's more about, not about, like, well, who do you syndicate to, but it's about talking about the business and then, going through that same allocation. It's like, well, where do you want to spend your next dollar? They kind of know it, right? They know intuitively, like, well, yeah, I'd rather just build right next door, because, but they don't, it doesn't come out in the spreadsheet. So you got to kind of really kind of then take it to the next level, work through unit economics. It's really a drill. And so I think, obviously the guys who have been through it a number of times, they know that intuitively, and it's already in the model. Sometimes it just takes a little, asking a lot of questions and really kind of understanding the business a little bit, and moving to the next step.
Well, you know what? Can I just jump in on this? Because I think you asked 2 questions in there, or Jeff at least answered 2 questions.
2 or 3.
2 or 3. And he's spoken too much already on the panel, so we need to dominate the rest of the time here. No, but look, in terms of capital, I think, there's capital sources and capital outlays. On the capital sources side, I think as a provider, debt is going to be our preferred capital source, but we have to recognize the balance of leverage inside a public organization, particularly because if you can get to investment grade, I think you get a lot of benefits in terms of equity multiples and interest rates. And you can see in the environment today, interest rates are beginning to rise, and so you want to be well positioned against potential movements in your cost structure longer term. Thereafter, we would prefer equity. Equity can be challenging because the public markets know generally when you need it. As a REIT, we take advantage of an ATM, which is a way of going to the market on a regular basis in small chunks. So not to disturb sort of the balance of buys and sells out there, but allows us to tap the equity markets on a regular basis. And then sort of, no offense, Bill, but as a last resort, go to really expensive equity, which would be private equity. Everybody keep your hand on your wallet. But I'll tell you, the reality is that things are moving so quickly that the need to access significant amounts of capital in a short period of time does drive us to look for partners like Stonepeak that do have large pools of capital that really understand the space and can put that capital to work in partnership with an organization like ours in a very short period of time. I just want to say one thing on the allocation front, because Jeff was talking about how you allocate capital. And I said before, organic, we get a higher return. I'd also tell you that in the US, the returns are higher on development than they are in Europe, whether it's the cost of land and power or it's tax leakage, given that we're a REIT here in the US and we don't pay the same taxes. The returns are going to be higher here, but the question is, as we allocate that capital, not necessarily just what the next dollar's return is, but whether having that corresponding footprint in other markets means that we will do better globally as an organization. And so sometimes you're making a decision which is best for the organization, but might not be best on a sort of, all right, where does this dollar get the next dollar get the best return? You have to look at sort of the big picture.
So given our time allocation here, and also perhaps a little bit humbled by the fact that we have one of the founding architects of the internet in the audience here, I'm going to venture into the crystal ball aspect of the question here before we open up to the audience. I'd like each of you maybe to talk a little bit about your predictions, and you can comment on this from the point of view of, cross-border strategies, companies completing their sort of product components, or from a sort of capital markets perspective, looking out a few years. In your case, Jeff, what you kind of see as the evolving themes that are maybe important for our constituents here in the audience that are the logical communications infrastructure and services operators around the globe.
Happy to start. We could have spent 30 minutes on predictions alone for the future, but to keep it simple, absolutely believe M&A will continue to accelerate. We'll see this industry consolidate as rapidly as new companies are entering the space. Folks are going to get bought, and scale is increasingly important to attracting new capital, particularly from the equity markets. If you look at the percent of the space, the data center space, that is owned either by index funds or REIT-dedicated funds, which are effectively index funds, it's about 60%. It's one of the highest of any subsectors out there. And so as capital rolls, particularly from a real estate perspective, from slow growth areas to high growth areas, like data centers, it's not necessarily being put into the names that have the best growth prospects, but it is being put into the names sort of arbitrarily that have the largest market cap. So M&A is critically important to attracting capital, but also to serving that contracting basket of customers. That is, fewer customers are going to drive more of demand. The other thing I think is going to be critically important over the next several years really is SDN as a solution for creating the fabric between private and public cloud resources. And so from our perspective, we're very focused on the evolution of network topology, SDN being sort of a near-term one, and M&A.
Excellent. Bill?
It feels like the growth drivers for the traffic volumes look to be set. So I don't see any dislocation happening this year or next year on the growth drivers, so accelerated growth. And I think scale matters. I think Jonathan was making that point. We're seeing scale of data centers and subsea cable and fiber optic builds that no one's even dreamed of. So I think increasingly as we get into more and more, that scale is going to really matter, which I think triggers consolidation. But I think the challenge for the operating executives who are running companies right now is how long do you try and run as an independent company versus be consolidated?
Right.
That's I think, the question they're going to have to ask themselves.
Yeah, and actually on a panel that I was on yesterday as well, the scale element was actually translated in most of the discussions into competitive advantage vis-a-vis unit economic elements. And being able to differentiate ultimately in the marketplace is a strategy point, whether you're doing that on scale and unit economics or you've got a more insurgent type player that has another differentiator that may not just be all unit economic based. But I think that is the essence of opportunity across this space.
Yeah.
Jeff, maybe comment too on...
So I'll piggyback off of something Jonathan said, which I think going back in time a little bit was kind of a sea change of kind of the capital formation and aggregation, and it's this REIT status of companies is, digital going REIT, kind of Equinix, CyrusOne, the number of companies attaining REIT status, which then provides, obviously some benefits from just a structural standpoint, but then also puts you into another capital, kind of aggregation model, right? And your point was well taken, I think, which is the driver here is that it continues to grow, investors chase growth. You look at other retail, other kind of REITs, retail, whatever it might be, slower growth, maybe even negative growth. So it's just not attractive, right? So money flows pretty freely between those if you're a real estate investor, so you're going to seek that, kind of like higher growth. And the same thing with infrastructure funds. Like we've seen huge infrastructure funds being raised, with capital all around the world, not just in the U.S., and needing to deploy that capital. So that's driving the M&A, that's driving this bigness, right, of that we talked about. And I think going forward, the capital that's being deployed, I think it feels like almost a barbell situation. Your centralized cloud, hyperscale type facilities, that are fairly, significant in size, house the content guys, house the cloud guys, where a bunch of compute is going to be kind of like centralized. And then over here is on the edge. I can't believe it's been this long. We haven't even mentioned the edge today. So, these these very small, kind of like, content, kind of holders, at the cell sites, in neighborhoods, in kind of suburbs, kind of like trying to get the content out to the edge, out to the consumer, and then move back and forth as fast as possible with IoT, with driverless cars, with all the information that's going to be kind of needing to be attained at the edge through the wireless network. I think that's the other place where I think people are spending time trying to, kind of think about capital and how they might deploy it.
Yeah. One last question, and then we'll see if the audience has any questions. Both of you, John and Jeff, commented on the REIT sphere, and obviously the REITs, particularly in the data center sphere, have benefited from 3 layers of advantage. One is cheap debt capital that has been able to leverage these opportunity sets, good growth characteristics, generally both organic and inorganic, and last, the tax advantage of the sort of equity participation for investors. And that's driven to valuations that are extremely attractive. One of the questions that's come up in a bunch of forums here over the last few days is what happens to the inverse, to your point, Jonathan, that interest rates are starting to show signs of rising. What are the implications for some of the REIT-centric players with that possible eventuality?
Well, so there's a lot of different impacts, right? We've all seen the charts, right? So we look at the math. When interest rates go up, REITs are generally trade down, at least during the period where interest rates go up. I mean, ultimately, right, REITs have to pay this dividend. The dividend is then sort of an alternative interest investment relative to a government security. And if that government security, which carries no risk, goes up, then we're going to trade at a lower multiple. That being said, I actually think rising interest rates will be really healthy for this industry. First of all, certainly what we see is more and more, certainly on the private side, players using significantly higher leverage than we would be able to get away with as a public company. If interest rates go up, that's going to squeeze their returns, and I think it'll make the competitive field a little bit more stable. I also think that it will be a positive because as interest rates go up, it pushes on a trend towards outsourcing, and ultimately outsourcing is one of the primary drivers of demand for our space or for cloud companies, which in turn, there's demand for our space.
There is a benefit, by the way, of interest rates going up. Typically, bank stocks go up when interest rates goes up, so that's good. We got to make money. So.
Bill,
No, I'm just pointing out.
Oh, we're out of time, it seems. So, if anybody would like to ask a question informally, I guess on the way out, we'd welcome it. But thank you all for your time and attention. Hopefully, you've enjoyed our discussion, and look forward to seeing you at the next PTC.